Hello, everybody, and welcome to our Q2 Manufacturing Outlook webinar. In terms of the overall headlines for today, just to give you an overview to start us off, we have seen, as with the last Manufacturing Outlook webinar, the gap between output and orders has stayed quite significant. In fact, it has increased this quarter. Domestic and export orders are continuing to trend down, and as a result, prices have gone up, but profit margins have been reduced. The consequence of all of this is that investment continues to be paralysed, but on the positive side, the unexpectedly positive performance from Q1 means that we have slightly revised up our growth forecasts for the manufacturing sector in 2019. We had expected a contraction. We now expect a very slight level of growth of 0.2%, but we have revised down our growth forecast ever so slightly for 2020. We now expect a growth of about 0.8% for that year. And in the macroeconomy overall, we expect a slightly improved growth of 1.2% in 2019, but again, a slightly reduced growth in 2020 of 1.6%. So what does that mean in terms of the details that we're seeing from businesses, and why have we come to those conclusions? Well, firstly, we can see that the gap between output and orders has increased. Production has continued to boom relative to orders this quarter, and that is despite the fact that we have had some obviously very poor and worrying headlines coming from the steel sector and from the automotive sector in particular. We saw in Q1 the highest level of stockpiling ever recorded in G7 history, and that explains that gap between the red and the orange in those last three lines to the right there, circled in blue. What this has meant now, and what we have deciphered from the latest data, is that those stockpiling activities that took place in the first couple of months of this year, as people were preparing for a potential no-deal Brexit on March 29th, the original exit date from the EU, we saw imports rocket up by an unprecedented 11% at the same time as exports declined, and warehousing demand also shot up by an unprecedented 32% as firms sought new places to store their goods in preparation for potential disruption that might have been caused had we left with no deal on March 29th. In terms of the next slide, you see the reasons for all of this. So domestic and export orders are trending down. They have been doing so for some time. This is the second quarter in a row that UK orders have exceeded export orders. And the significance of that is quite worrying, because it's not the case that UK orders have increased. It is the case that, in fact, both export and UK orders are decreasing. So customers are no longer buying as many UK goods from overseas, and that is having a knock-on effect in terms of the domestic economy as well. Interestingly as well, UK orders haven't exceeded export orders in recent history. In fact, the last time it happened was in 2016. So this again suggests that it's probably linked to Brexit activity, but it's not just Brexit and foreign customers abandoning UK supply chains. There's also an awful lot going on in the global economy that is affecting performance. So a general economic slowdown. In the EU's case, Germany, the traditional powerhouse of the Eurozone, has finally started to slow down as gravity has caught up with their economy. Many economists have predicted that Germany would start to peter a little bit for many years, and it has defied expectations for a long time, but it is finally catching up with reality. Equally, Italy is continuing to struggle. At the same time, the Chinese government's policy of relying more on domestic producers and reducing their reliance on imports is having an effect, because it's such a sizable economy in global terms. And added to that, the growing trade tensions between the US and Iran and the US and China is also having an effect on the global economy, which is feeding into this overall economic performance. Of particular note, I think, is the fact that orders from Asia and Europe remain weak. They have gone slightly up when compared with Q1 of this year, but this is the second lowest orders level that we have seen from both Asia and Europe since 2016. The lowest on record since 2016 was, in fact, Q1 of this year. What we are hearing anecdotally from our members is that they are being told by customers of theirs in Europe that because of Brexit uncertainty, because of firms' caution around doing new deals, buying new goods from the UK, for fear that when those goods arrive, we may have left the European Union without a deal, and therefore they would be liable to pay extra tariffs under WTO terms and meet new regulatory requirements. Customers on the continent are now looking to source goods that they have historically bought from the UK from elsewhere in Europe. But interestingly, we are also seeing this in Asia as well. So countries that we trade with in the Far East via the benefits of EU free trade agreements are also aware of this, and they're looking to source their goods elsewhere. That's of particular note are Japan and Korea in that context. That being said, the traditional three big export markets for UK goods are in order. The EU, North America and Asia as number three. Last quarter, Q1 of this year, we saw the Middle East become number three because of a decline in exports to Asia. We have now seen Asia return to its typical place as number three on that list, but again, that is not because of an increase in export orders from Asia, but rather because the Middle East has also started to decline. So quite worrying story there. If you look at the breakdown across the various subsectors, I think that the biggest story here is that metals has moved into negative territory. That line, the navy blue line with the arrow just to the right, that really is the impact of the troubles that British Steel is currently having. That will have knock-on effects throughout the rest of the economy because so much of UK steel is so important to so many other sectors, particularly the metal products subsector and the mechanical equipment sector. We see on the mechanical equipment sector, the navy line on the right of that subsector also looking quite low when compared with the previous blue line. That is a sign of a lack of investment. Mechanical equipment is really the subsector that shows when businesses are investing in new technologies, investing in things that help boost productivity. Because of all of this uncertainty, we've seen that stagnate, and that's a real symbol of the impact that all of this Brexit delay and uncertainty is having on the UK economy. We also, as I said, expect a knock-on effect from the difficulties that British Steel is having throughout other sectors, metal products, mechanical equipment. The automotive sector buys an awful lot of steel from the UK as well, so possibly an impact there. That being said, bucking the trend, the column on the right, electronics, is doing rather well. It is sort of insulated from all of this Brexit and global uncertainty because it is quite a global sector in terms of where it trades to. It's quite niche as well, and it's heavily influenced by the trend towards automation around the world. So it's thankfully bucking the trend, but it's really the only outlier in that sense. All other subsectors are not doing so great. On the ground, we're hearing that the impact of all of this means that we have seen from Q1 record levels of employment, so the tightest labour market on record, the highest number of people in work in history, the lowest number of unemployed. And the result of all of this is that we have a very tight labour market, which is increasing input costs for firms. At the same time, a slight increase in oil as well, meaning that prices have gone up. But those price increases have not been passed on to consumers, so profit margins have been reduced. And the consequence of that is that we're hearing anecdotally a number of firms, particularly smaller firms, reporting cash flow concerns. The other worrying trend in this is that we have seen productivity growth, as defined as output per worker, coming in as negative for the third quarter in a row. That's a really worrying sign, because in the end, productivity is where all future growth and future wage rises come from. It's where profitability comes from as well. So any lag or slowdown in productivity, which has been underperforming really since the turn of the millennium in the UK, is quite concerning. That being said, despite all of this doom and gloom, confidence, as reported from our survey, has gone slightly up. Thankfully, we avoided a potential no-deal Brexit on the 29th of March, and then the extended deadline to the 12th of April, we avoided another no-deal Brexit. That deadline has been extended now until the end of October at a maximum. So firms are a little bit more confident about their own performance. But the interesting thing about this particular slide is that divergence between the orange line at the bottom and the red line line at the top. So the orange line at the bottom is UK economic conditions, and the red line at the top is your own firm's business performance. What we typically see is that firms often expect a lot better from their own company than they do from the overall economy. What we're seeing now is that trend, that gap between those two lines is widening and has continued to widen over several successive quarters, going back really until since the Brexit referendum in 2016. So firms still relatively confident about their own performance, but their expectations for the overall UK economy seems to be trending down, broadly speaking, which is a worry because it is the one that really determines an individual firm's investment decisions. You might be confident in your own firm's robustness, but if the overall economy isn't doing well, that will affect the decisions that you make. And unfortunately, that means that a further slowdown in the economy is expected. We have seen 4 quarters of consecutive decline, 6 if you take out the cyclically boosted performance in Q2 2018, which came from that being the period of building into Christmas, which is obviously a very important time for many firms. So really, confidence in the future prospects for the UK economy is not looking great at the moment. And the result of that is that investment has really been paralysed. You'll see on the right there, circled in blue, an uptick on the orange line. That is the effect, the artificial boost that came from stockpiling in Q1. As investment has now receded back to its normal trend because of that stockpiling ending, we're seeing the orange line turn down again, a sign that things are not all that great at the moment. That being said, employment has been quite strong, but employment intentions remain weak. Equally, investment intentions remain weak. This is, again, the consequence of cash flow problems, the consequence of uncertainty around future trade relations, the fact that so many firms around the world seem to be divesting themselves of their reliance on UK suppliers and are looking elsewhere in new markets to source goods that they once bought from the UK. Of particular note, again, in this period is that April, the key month for salary reviews, is contained within this survey data. So what we have seen from this is that about 10% of pay settlements have been deferred from April until after October of this year, people waiting to see the outcome of Brexit, and whether we have another extension, whether we leave with a deal, whether we crash out in October. What happens there will have a big impact on firms' ability to invest in their employment decisions. At the same time, if you include those settlements under review, that number increases to 25%, which is really an extraordinarily high level when compared with previous years. And we know that 5% of firms have frozen their salary of their workers for the time being. So the impact of all of this is really hitting the bottom line for workers themselves. At the same time, investment in the overall productivity of a firm has contracted for 4 quarters in a row. That's the first time that has happened since the global financial crisis in 2008, and really shows the impact that all of this is having on firms' confidence and their ability. As we flick through to the final slide, one positive, I suppose, you could take from this is that while we had expected a slight contraction for the manufacturing sector this year, because of the artificial boost that we got in Q1 from stockpiling, and based on the latest data that we now see, we have revised up our growth forecasts for the year, and we now expect growth in manufacturing for 2019. Having previously expected a contraction, we now think we will get very slight uptick of 0.2%. That's 0.5% higher than we had been expecting at the start of the year. That being said, though, for 2020, we have slightly revised down our growth by a little bit over 0.5%, 0.6% in 2020, less than we expected. We now expect growth to be about 0.8% overall for the year. In the macro forecast, we have revised the overall economic expectations up by 0.1% to 1.2% for 2019, but down by an equal 0.1% in 2020 to now expected growth of 1.6%. So that is where we are overall with the latest stats. A lot in there to digest, some of it positive, some of it negative, but a lot of wait and see as well.
Brilliant. Thank you, Seamus. We've had a couple of questions come through, and a lot of the information you've already answered. I think one of the questions which I'd shared with you was around manufacturers holding off investment. So the question is, what impact is this going to have? Is this going to have on the market and its performance, so efficiency? and when is it likely investment's going to start coming back in? So is there an opportunity cost for people holding off investment?
Well, this is an interesting question for a couple of reasons. Typical economic theory would suggest that what we're seeing now is offset investment. So firms sitting on piles of cash, holding off the money that they have, just in a wait and see moment, hoping to get some clarity on Brexit. And then once we get that clarity, they will make those investment decisions, and investment that would have otherwise taken place this year will take place in future. That is possible and may well happen for many firms, and we certainly hope it does. Typically, when it does, it means that you see a very significant uptick in growth and a lot of improved productivity and firms doing exceptionally well. That being said, the fact that we're hearing so many firms reporting cash flow problems suggests that at least for smaller firms, that may not be the case. It doesn't seem that they are sitting on piles of cash. It is in fact the case that their input costs are going up, their profit margins are going down, and they're really being squeezed at both ends by all of this uncertainty. And the ultimate effect of all of this is that productivity will continue to lag. New firms or firms will not invest in new technology. What investment has taken place recently has largely been in hiring extra workers, which in itself is a good thing for the overall economy, but it does suggest that investment is being put into what economists would consider less productive means. So firms not investing in new machinery or technology, but investing in extra workers instead, because should there be a downturn, should your back be put to the wall, it's easier to let those workers go than it is to write off the costs of machinery that you've just installed. So this is really not an encouraging sign. There's a lot of uncertainty out there that's affecting firms' ability to grow for themselves, and if the impact of all of this is a knock-on effect in terms of how we are able to produce for the customers that are buying our goods, and it makes it more difficult to sell to them and they start looking elsewhere, well, that will have a lasting effect too. So we would hope to see an increase in investment once we get over the October deadline, assuming of course that there is a deal so that we leave the European Union under agreed terms and in the most stable way possible, but we will have to wait and see.
Okay, brilliant. That's all the questions, and we hope you can join us for the Q3 webinar in September.